Now, it has been a week of a dream run for the Nifty. We've hit 21,000 on the index in intraday trade today, and we eventually closed the week above the 20,900 level, which is quite high. And guess what? Christmas is still more than a fortnight away. So this has to be the longest buying streak that we've seen in the last 3 years. So what is this bull run all about? Is India actually cashing in on future growth, on a projected kind of rise? We'll get to that with our guest, market veteran Ajay Bagga is joining us in a moment. But let's get you a round of this week's market action first. And for that, my colleague Ansh Bhilwar is joining us here in the Mumbai studios. Ansh, the bulls are quite clearly on a rampage of sorts, no breather at all. Walk us through the big week we've had.
Nifty touched 21,000 level for the first time, gaining over 3% this week. This was the biggest single weekly gain in over a year. In addition to that, Nifty also advanced for 6th consecutive week, which was the longest buying streak seen in almost 3 years. Talking about other broader indices, Nifty Mid Cap and Nifty Small Cap also touched record highs, gaining 2.4 and 1.1% respectively. Moving on to sectoral indices, Energy was the top sectoral gainer, gaining over 7% to touch record highs. Talking of which, other indices also touched record high levels such as Nifty Realty, Metal, Auto and Nifty Bank, all touching record high levels this week. Whereas Nifty IT touched 2-month high led by TCS, L&T Technologies. While on the losing front, Nifty Pharma was the top sectoral loser this week. The index snapped 5-week gaining streak dragged by Torrent Pharma and Lupin. Whereas Nifty FMCG was down by 0.4%, mainly dragged by Imami and Varun Beverages.
Ansh, thanks very much for that. Gives us a sense of what went down in trade over the week gone by. But let's get a sense of what could happen in the weeks to come as we head into Christmas. And for that, market expert Ajay Bagga is with us. Mr. Bagga, it's always a pleasure talking to you. Markets now at 21,000. Would you say this is the time to book profits or press on with further investments, especially in large caps like many are suggesting?
Yeah, the switch from mid and small caps into large caps is happening, though we are not seeing in the SIP numbers. The SIPs are still coming largely into mid and small cap funds. But overall, institutional players are cautioning that move into large caps out of mid and small caps. But Vikram, what I would say, as we saw on this Monday and Tuesday of the week gone by, market returns are very lumpy, and a few days will give you mostly the entire year's return. So if you're not invested, you will miss out on that. The sharpest investors are the Indian retail investors who are doing these SIPs into mutual funds, and so regularly putting fixed amounts into the markets. That's what works best for the large portion of retail investors. I'm not saying to book. I don't think this story of India is getting over. It's a multi-decade story. It's a structural story. And there's a huge shift on in our manufacturing base, in our defense indigenization, in our infrastructure spending. All of those will have multipliers, which will also impact your stock market. So as the economy goes from 4 trillion to 6 trillion to 10 trillion, your markets will also rise in not even in step, but in anticipation of the economic growth. So this is the start of a structural India story, which is multi-decades long, not to take money off the table, but to keep investing.
And like you said, SIP is the route to do it. So that the structural story, you need a structural approach to investments as well. These SIP numbers, we were just talking about them. Ajay Bagga just pointed it out. Now we've crossed 17,000 crore levels, and now we find ourselves at record highs. We got in a word from NS Venkatesh, the CEO of Amphi. Amphi puts out this data. This is what he had to say about it.
We are very glad to see that the SIP number has gone above 17,000 crore, and the investors have continued to repose faith in the mutual fund as an investment vehicle and used SIP as a route for investments. We are seeing positive sentiment from the retail investors when they are investing through the SIP route.
So Ajay Bagga, you pointed out that economic growth is a multi-decadal story for India. And if we have to align our portfolios with this reality now, with the kind of growth sectors that would find maximum impetus, because some of these sectors, you find a lot of the capital expenditure coming in from the government side. We're not seeing it so much from the private sector. Those have to be kept in account when deciding how you're going to align your portfolio to India's trajectory of growth. How exactly would you suggest one should do it?
Yeah, it's a very good question. And, the answer can never be adequate because it's an evolving journey. But sitting where we are right now, what is happening? There is a huge impetus to the infrastructure sector from the government. And Vikram, what happens is with political stability and as the capacity utilization starts reaching the 80s, you see that fresh private capex is a follow-on investment that comes in. So out of about 11 lakh crores of profits that Indian corporates make in a year, roughly about 7 lakh crores used to get invested back. That has fallen sharply over the last decade to about 3 to 4 lakh crores. After the great infrastructure push of 2018 to 12, we saw the capex dwindling, and corporates were focusing on rebuilding their balance sheet, so that twin balance sheet problem in India of banks having high NPS and corporates being excessively leveraged both got resolved over the last 10 years via this. So now we are sitting on a spring ready to spring forth with private capex. I think that will be a follow on. Maybe by the second half of next year, we start seeing that trajectory where again 7 lakh crores of private capex starts coming in, like we used to get earlier on. The profit to GDP ratio has recovered quite well from about the COVID era low of 2 to 3% of GDP. It's nearly 6% of GDP. And then this profit gets spent in private capex. That's going to give you a very Goldilocks effect along with the government infrastructure. So in that kind of a scenario, what do you have to bet on? First, who's funding all this? That's your financiers, your banks, your NBFCs, your mutual funds, your insurance companies. All these will be getting a multi-decade boost as this goes on. Second, the actual executors of this push, your infrastructure companies, cement companies, home material companies, real estate companies, all these are going to be beneficiaries in this infra push. Then you add on defense and railways, because that's something where government has done a good job by listing a lot of railway companies. If you see the Vivek Devroy committee report, they had identified 21 railway companies that could be listed. Still, we have less than double digit. I think more can be listed, and you will see value unlocking happening for these. So railway, defense are again very sweet sectors which should do well. These would be my topics for the coming year, Vikram.
It's very important to understand at one level what the government's policy is going to be on the fiscal side. We are going into election mode, and that we need to kind of keep in mind, because there would be certain populist measures that would be announced, and what could be coming our way by way of an interim budget is something that we could factor into our strategy, at least in the short term. But it's also important to understand what our RBI's monetary policy is. And today, we're getting a sense of how they've gone ahead and kept those interest rates unchanged. They've kept their stance as withdrawal of accommodation. Let's just listen in to what the RBI governor said when the MPC decision was announced earlier today.
The MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation.
So what would be our largest takeaways from the RBI's stance? Clearly, as far as economic growth is concerned, the GDP is kind of beating the projections made by the RBI, Ajay Bagga. Now looking at their stance so far, looking at the possibilities going ahead by way of what the RBI could do, how we should be playing our rate sensitives within our portfolios, what should be a good, robust strategy according to you?
Yep. It's a good time to start locking in longer durations. You will benefit both from capital gains as interest rates come down over the next 1 year. You will get capital gains, plus you will get very high coupons. So fixed income investors can play the duration play. Quite clearly, what is the RBI signaling, Vikram? One, it is a hawkish pause, but this is the fifth policy in a row right from April onwards. They were ahead of the curve in pausing. The Fed paused in July, and I think next week the Fed will continue the pause. RBI paused in April, and they have held steady since then. But it is hawkish because the inflation target of 4% is still to come in a durable manner. So they won't be in a rush to remove the withdrawal of accommodation stance of the policy. One hint that all of us should look out for is look for RBI turning neutral in its policy stance. That will be the precursor to a rate cut. I don't think they will do that before March, April. March, April, probably they will change the stance to neutral, and they'll say we are on a balanced scale. And maybe after that, June, July is when you will probably get the first rate cut from RBI. That's what we could read between the tea leaves today. The second big thing is growth is very strong. So 7% real growth translates into 11 to 12% nominal growth. Your tax numbers are looking very good. Direct tax will probably come in 15% better than what was budgeted, which was already a pretty high number. And above that, we'll probably make 1.25 lakh crores, which is quite able to fund the slippages of the government or the vote on account, the supplementary grants that the government has asked for. We are not talking of indirect, still indirect. Also, I think you will get a double-digit outperformance. So there is a lot of fiscal space, Vikram, for the government to spend going into the national elections. We are not expecting a welfare explosion. Rather, it will be a calibrated, targeted kind of dispensation of the excess fiscal space that they have collected. Third is inflation. They brought it largely into control. It's not at the 4% target yet. November and December will probably shoot to 5.5 to 5.7 again on food prices going up, cereal prices going up. I think that will be an overshoot. They have factored that in, but then it starts slowly following a trajectory downwards. So I think we are sitting in a good space. RBI has done a good job since last May when they started raising rates. They raise rates quickly and then they have gone into a pause mode. The pause stays for next 5 to 6 months,
Yes.
and then the rate cut comes. That seems to be the broad lesson we can draw from today's MPC.
So prudent moves by the RBI, economic growth at a steady pace, and that economic growth is giving more to this bull run as far as the equity markets are concerned. So it isn't existing in a vacuum, and that is probably why we are seeing SIPs move up in a robust way as well. And perhaps we'll see the markets move up that much more, aligning our portfolio to the kind of strategy that Ajay Bagga is suggesting might be a good idea at this point in time to be able to make the most of how the markets are going to move, at the pace at which the markets are going to move, and the direction in which the markets are going to move. Ajay Bagga, it's always a pleasure getting in your perspective on the markets. Thanks indeed for joining us on this edition of India Tonight.